The Federal Reserve has delivered what was a much anticipated rate hike. There was a lot of questions and uncertainty from the broader markets. Would it be 50 basis points? Would it be 75 basis points? And what would it mean for the trajectory of the economy moving forward? Well, we've begun to get some answers. First and foremost, it was a 50 basis point rise. The rate is now at 0.75%. But we also got some insights about the future trajectories of the rate rises, as well as balance sheet unwinding with quantitative tightening. And we'll be unpacking and discussing all of these later on in the video. Interestingly, with a 50 basis point rise, which was the biggest rate hike since 2000, you might be wondering, how did markets react? We actually had one of the best days in the past 2 years. The S&P 500 was up by 2.99%. The Nasdaq was up even stronger by around 3.2%. There was green almost everywhere across the boards. The 10-year yield is in and still around that 3% mark, but it's at 2.94% on that benchmark 10-year. And the VIX retraced as well to the 25 level. But of course, with all of those questions, with everything playing out on the markets, you might be wondering, what happens next? And so, of course, we're going to unpack that question. And we'll actually be talking about the Federal Reserve statement, where they gave us some insights about where they think things might head from here. But before discussing that, it makes sense for us to take that step back and think about why. Why are we in this position? And why are the Federal Reserve rate hikes so hotly anticipated? As we know that inflation is at multi-decade highs. We've got the highest inflation levels in over 40 years. And so the Federal Reserve, as well as other central banks around the world, have put inflation at the top of their focuses, and they need to curtail inflation because it's affecting cost of living, and of course, there's implications throughout the broader economy. We know that the central banks around the world had a coordinated focus to help to navigate the virus periods, the lockdowns, and the pandemic. As a result of that, they helped to navigate and avoid a major virus financial crisis. But now the question is, have they left it too late to turn off the tap and to pull back some of these emergency time measures? We know that the focus will be to raise interest rates, to curtail demand, and to bring in and rein in inflation. But there is obviously a risk to economic growth as well if they raise rates too quickly or too high. And of course, this is where the question of will they be able to navigate and stick this soft landing coming into play. The soft landing just simply refers to the central bank's ability to hopefully navigate this period, to raise rates to a sufficient level where they can rein in inflation, but not to a level where they will inhibit and hamper economic growth and potentially send the economies into a recession. And so then that brings us to the question, will they be able to navigate the soft landing? The Federal Reserve have provided us with some insights throughout this statement that accompanied the rate hike decision today. So let's go through it. Let's unpack some of the key takeaways and, of course, explore what this could mean moving forward. So as we can see here, first and foremost, they've highlighted that although overall economic activity edged down in the first quarter, household spending and business fixed investment remained strong. This, of course, refers to the retracement that we saw in GDP. It was actually a surprise miss to the downside. Thoughts were that there would actually still be growth, albeit slow or lower levels, but there was that move to the downside. And however, household spending and the consumption remained resilient. We all know that there is a tight labour market. It's been incredibly tight around the world. Of course, there's been a range of different factors contributing to this, but job gains have been robust. Unemployment rate has declined substantially as well. Through that all, however, inflation remains elevated. There's supply and demand imbalances, and this is not new to anyone. There's a few different factors that they've called out here. Pandemic, higher energy prices, and of course, broader price pressures that are starting to flow through. As rising input prices rise, of course, then producers and companies have to make that decision. Do they bear those costs? And of course, that's a reduction in margin. Do they try to pass them on to consumers? And if they do, what will that mean for demand? Will there be demand destruction? So it has the ability to flow through more broadly. They've highlighted Ukraine here, and of course, first and foremost, the tremendous human hardship, but then the economic hardship as well. Implications for the economy are uncertain, and they've also stated that the lockdowns in China may exacerbate the supply chain disruptions, this is an evolving situation too. And this is where the interesting discussion around the rate hike comes in. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. So we understand they want to see inflation at 2% band on the long run. But this is where the fascinating insight is. With appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labour market to remain strong. And so they believe that they can navigate this soft landing, that they can bring inflation down to their 2% level within their stated guidelines, but also to maintain a strong and robust labour market without hopefully sending the economy into recession and avoiding that economic slowdown. And so, in support of these goals, they've raised rates to that 0.75% level, 50 basis point rise, and they've anticipated, and this is not surprising anyone, that there will be ongoing increases. This is not the first or the second rate hike in the cycle, obviously, now the second rate hike, but this is not going to be the last one. They anticipate there'll be further moving forward. And in addition, the committee decides to begin reducing its holdings of Treasury securities on June the 1st. And we'll talk about what this means later on. Essentially, we've seen expansive quantitative easing, one of the largest quantitative easing program that we've seen in the history of the world through the pandemic and everything that's flown out of that. There was, of course, coordinated support to navigate this difficult period, but this has led to a significant expansion of the balance sheet. And now they're looking to unwind the balance sheet, begin quantitative tightening. We know that there's around a $9 trillion balance sheet in the United States. And so they're discussing how they'll unwind that and what that process will look like. And then there's a bit more insight about this pathway up ahead. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information, which makes sense. They're prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. And they've provided those goals up above, so we would know what they are. We know that they want to make sure that there's maximum employment and, of course, bring inflation down. And so then just building on that discussion, this is the plans for the unwinding of the balance sheet. There was initial principles that were provided in January 2022, but now we're getting some more insights about the pathway up ahead. So the committee intends to reduce the Federal Reserve securities holdings over time, beginning on June the 1st. So that'll be starting next month. As we can see here, for Treasury securities, initially the cap will be set at $30 billion. That will rise to $60 billion after 3 months. So they're having a scale-up program. They're not starting at the maximum level, but they will do that over a 3-month period. Then mortgage-backed securities will be $17.5 billion, similar scale-up program to $35 billion. So what's that telling us? For a bit of a context, the balance sheet currently sits at around $9 trillion. So initially, in that first month from June the 1st, we get $30 to $47.5 billion a month. And then once we get to maximum capacity, which they've already highlighted previously, as we know, it was going to be $95 billion per month. So if you think about it, $95 billion per month at maximum scale over a 12-month period. Each year, they'll be unwinding around about $1 trillion worth of capacity. Obviously, with a $9 trillion capacity, if they do this out to 2024, over the 3-year period, that'll unwind $3 trillion worth. And so, of course, this final data point here provides that for us. The committee prepared to adjust any of the details to its approach in light of economic and financial developments. We know that the world is an evolving situation. It seems like we've had a significant macro event happening basically month in and month out since 2020. So they're going to have to be flexible. They're going to have to be fluid, but at least we've got a trajectory. We've got a guideline, and it'll be fascinating to see where things head. And so the question is, with all of that, where do things head from here now moving forward? I'd love to know your thoughts on it, so drop in a comment below. But we do have a few data points at the moment, and of course, we're waiting for plenty more insights and data points in the periods up ahead. What are some of these key factors? Firstly, we have a strong economy. The economy has been robust thus far, and it's been able to navigate and weather a range of different storms. Of course, the question is what happens as crisis time, accommodative settings are taken away, as the fiscal tap is taken away as well. But thus far, the consumer has been resilient. There's solid household savings rates. Of course, those are starting to come down, but the consumer has been resilient so far. We've seen that earnings have been solid across the board too. Of course, the question is, as we head into Q2 of 2022, with more supply chain issues, with implications from the war and all of the supply chain bottlenecks that flow through, and of course, prices that will likely have to be continuing to rise if input prices continue to go up, how will the consumption levels fare during that period? There are a number of other unanswered questions as well. How and when will inflation fade, and to what levels will that start to subside, potentially in the second half of 2022? Supply chains. Will those supply chain bottlenecks start to ease as the mobility restrictions ease, as border closures start to fade, and we see the world get to a more normalized and opened up economy? And of course, as we talked about before, how strong is demand and how will the consumption go without the support? If you are interested in many of these broader questions, here's other videos that you can check out after this one. But ultimately, the question is, can they engineer a soft landing? Jerome Powell and the Federal Reserve seem to think so. We'll wait to see how the central banks go on this question. Thank you so much for joining us. For now, stay well and happy investing.